Welcome, and thank you for joining today's F&B webinar on the federal tax reform announcement hosted by M&P. My name is Sean Crew, and I am a partner here at M&P and our Ontario Food and Beverage Niche Leader. I will be your host for today's session. Joining me today and presenting our materials are two of my partners, Rosario Suppa and Razik Sarsam. Both Rosario and Razik are seasoned tax practitioners and in particular are partners in our specialty tax service line. At the end of our session, we will share our contact details for any desired follow-up. You will have the opportunity to have your questions answered by Rosario and Razik at the end of their presentation. Questions can be sent using the chat feature on your interface. This webinar will be recorded and sent to all participants at a later date. Before we get started, I did want to thank Ezio D. Emanuel, Senior Advisor, Agri-Food Business Development, and former Federal Senior Trade Commissioner for helping us with our outreach to various food and beverage associations across Canada. In particular, I would like to thank the following associations for inviting their constituents to this webinar, including Food and Beverage Ontario, the BC Food Processors Association, the Alberta Food Processors Association, the Canadian Vintners Association, the Conseil de la Transformation Alimentaire du Québec, and the Canadian Food Exporters Association. Finally, I would like to welcome my fellow partners and most importantly, our clients who have joined the webinar. I will now pass it over to our presenters, Rosario and Razik.
Thank you, Sean. I'm Rosario Suppa. I'm one of the tax partners here at M&P in the Mississauga region. And along with me is Razik Sarsam. And we're going to talk to you this afternoon about the proposed tax changes that came out on July 18th as introduced by the Department of Finance, which obviously you've all heard about, and it's the reason for this webinar. There was no surprise really to this announcement. We did know that in the federal budget of this past March, we had anticipated a lot of tax changes, but nothing actually came through. It was much ado about nothing type of budget. It was so these proposals are no surprise. What is surprising to us though is the timing, and the timing, as you know, July 18th. Many people were on vacation or about to head out on vacation, and in fact, Parliament had recessed for the summer as well. The severity and breadth of these proposals is also very surprising to us, as you'll see once we get into some of the technicalities that we're looking at. And also the fact that they've given a very short consultation period. We've got until October 2nd, which is coming up in just days, for public comment and consultation through various professional and business associations. So you can see that it is very tight, and of course there's been a lot of hoopla in the media and among the associations and the public at large. And we'll get into some of the information now. So the three areas that finance is looking to hit. One is income sprinkling. Two is the use of companies to hold passive investments. And three is the conversion of income, what would normally be taxed as, let's say, dividends, into capital gains. And Razik will deal with that at the end. Income sprinkling was the first thing that they wanted to tackle, and this is more or less what we call income splitting. And it really is a strategy used by entrepreneurial families to split income among family members, usually so that they could use their lower marginal tax rates. The lower income individuals might have credits that they could also use, and definitely the capital gains exemption is a big benefit here. Many of you may be aware already that all Canadian resident individuals are allowed a lifetime capital gains exemption, which is roughly $830,000 now. This next slide here is a very common family structure that we see. Sometimes it involves a trust, and sometimes it doesn't. But it's a situation where you may have spouse A as a founder of a company and very active in the company, and perhaps spouse B and their adult children who may have minimal involvement in the company can also own shares. And those shares could be subscribed for at nominal amount, either when the company has started out or in some other fashion, usually through an estate freeze. And what this allows then going forward is that as the value of the company goes up, all family members could take dividends, and that could they could obtain the advantages of income splitting as previously discussed. So income sprinkling, benefits or common uses, commonly used to compensate lower-income spouse, used to fund maternity leaves, disability and sabbaticals, and usually something that might be counted on in low-income years. In practice, what we see a lot of is the use of funds to finance post-secondary education for young adults, and perhaps to provide bigger payments, or like down payments on principal residence or cars or so forth. On the next, this first diagram here, a numerical diagram, we show spouse A and spouse B, where spouse A is involved in a company, spouse B has shares but is not actively involved. Spouse A might take a salary of $200,000 during the year. You could give spouse B perhaps a dividend of $200,000. And in total, because they're using the lower marginal tax rates and they get 2 kicks at that, they're paying tax of about $125,000. If, on the other hand, they were not able to income split, and if spouse A, being the only active person, had to take all the income, $200,000 salary and dividend as well, that individual would pay tax of about $160,000 because they would be kicked into the higher tax bracket. So you could see in this very simplistic example that there's a savings to be had from income splitting between the spouses of about $35,000. Our next example goes a bit further, and this is one that is commonly seen when you have a trust, for example, in a family structure. Spouse A might still take the $200,000 salary because they're active in the business. Spouse B and 3 children perhaps might take dividends of $40,000. At $40,000 in Ontario, you're pretty much at a break-even point with no other income, where you're paying very little or no income tax. So you could see that total tax here on this large amount of money that's been paid to the family is about $73,000, whereas if spouse A had taken all of this income personally, they would have paid tax of about $144,000. So we could certainly see where the government is coming from with respect to these changes. So the government does have concerns because the current rules don't put any restrictions on dividends. Non-active shareholders can get dividends from a company. When it comes to salaries, there are rules in the Income Tax Act that subject it to reasonableness based on what the family members actually do for the company. There's also concern that when they're receiving sprinkled income, they may not have contributed to the business, and so these are the areas that the government is hitting on. So business owners' concerns, well, as you've read much in the media lately, the proposals will impact middle-class business owners, not just high-income earners. And on a lot of this as well, the government is trying to draw a parallel between employees and entrepreneurs. And we certainly know, if you're an entrepreneur, that there are huge differences in risk and capital requirements and so forth. And in fact, the Income Tax Act already has for many years provided incentives which distinguish between employees and entrepreneurs. So when it comes to income sprinkling, just to get into what the changes are, currently we have a system whereby tax on split income, it's a term used in the Income Tax Act, is taxed at an individual's highest marginal tax rate. It's also referred to as the kiddie tax, and under current rules, anybody under 18 years old who receives dividends from a private corporation is going to pay tax at the highest marginal rate, regardless of their income level. The income sprinkling is also looking to limit the use of the capital gains exemption for family members. So again, this next slide just sort of takes you through what I've just discussed, that the kiddie tax is currently in place, and it does attack anybody under 18 who receives dividend income, business income, and also if they sell shares or earn a capital gain on a disposition that is not at arm's length. Under the proposed changes, and this is where the big change comes in, is that the TOSI now, or the tax on split income, will now generally apply to all Canadian residents, not only to minors. So there is no age threshold. And it would apply if they receive income from a related business, unless that income is reasonable. And the reasonableness is a big issue and something new that's been thrown into these rules now. So basically, that all individuals now will be caught or can be caught, and if they are, they're what we term a specified individual. The proposed definition of split income is also expanded, so not just dividends or business income, but it's also going to include interest income. And a big one is it's going to include gains from the disposition of property or capital gains. It's going to include income from a conferred benefit, such as a shareholder benefit, and also secondary income or reinvested income. So what is this term reasonable? Well, basically, this has been thrown in to say that if you are a specified individual and you're earning dividends or being paid dividends from a private corporation, the amount of dividend has to be reasonable. And if it's not reasonable, the excess is going to be treated as TOSI and taxed at the high rate. So a reasonable test is based on what an arm's length party would have agreed to pay to the adult specified individual, considering labor contributions, capital contributions, and previous returns and remuneration. So when it comes to reasonableness, we've got very little guidance at this point, but basically this legislation splits adults into two categories. One is those that are under 25, and then adults 25 and over. And for those that are 18 to 24, basically if they're going to contribute or what's considered to be a reasonable contribution to a company, is going to be based on their labor contributions and or capital contributions. When it comes to labor, it's going to have to be regular, continuous, and substantial, which basically means it can't be part-time. Capital contribution, whatever they've put into the business, they can't just take any rate of return on it. It's basically going to be limited to the prescribed rate, which currently in the Income Tax Act is 1%. When it comes to adults 25 or over, the rule on reasonableness is not as stringent. Labor contributions do not necessarily need to be on a full-time basis, and capital contributions are not, or the rate of return is not limited. Okay, so what we really have here now is that this legislation as proposed, it's going to require a lot more consideration and a lot more debate to going forward, because there's certainly going to be a lot of uncertainty now as to what dividends are reasonable in any given situation. It's important to note that 2017 is likely the final year to pay dividends to adult shareholders without considering these rules. And definitely it appears that these rules will take effect July or January 1st, 2018 in some form. The feeling is a lot of this will carry into the final legislation, but possibly with some clarification on some of these matters. As far as tax planning goes, like I said, be aware that it's going to happen January 1st. You may want to pay larger dividends this year before 2018 under the old rules. Keep in mind that going into 2018, you're going to have a plan in place because if you do have adult family members as shareholders in the company or having some involvement in the company, you may want to firm that involvement up so that you know going forward how much remuneration or dividends is going to be reasonable for them. Expect more developments and information because this is a complicated piece of legislation. These TOSI rules, as I mentioned previously in the expansion of the definition, will also apply to capital gains. And basically the intention here is to limit the ability for multiple family members to claim their own full capital gains exemption on a capital gain from a sale of one private corporation. And that is really what the government is aiming at. So what they're looking to change, currently minors are allowed to claim the capital gains exemption. The Liberal government under this draft legislation will eliminate that ability or the ability for anybody under 18 to claim it. It's also going to provide a reasonableness test, same as the dividends, so that capital gains that have not met the reasonableness test in the past will not be eligible for the capital gains exemption. And a big one is that trusts will no longer be eligible to flow out capital gains to its beneficiaries so that they could use their capital gains exemptions. So basically 4 points to note here. is that after 2017, a minor will not be eligible for the capital gains exemption. To the extent that a capital gain accrued before the individual was 18 years of age, that is also not eligible for the exemption. So in a simple example, and we think that this is the way it's going to work, if somebody has held shares since the age of 12 and they are 30 years old when they sell the shares, it's most likely on a straight line basis that capital gain is going to be divided up into a portion that is eligible and a portion that is not eligible for the exemption. In addition, point 3 here, to the extent the capital gain accrued during a period in which a trust held the property, that capital gain will not be eligible for the exemption. And also, as I mentioned previously, if it's previously been subject to TOSI rules on perhaps dividends from the company, the capital gain to that individual would not be eligible for the exemption. Finance has built into this draft legislation some transitional relief. And the transitional relief basically is intended to allow individuals and also trusts that hold shares of private companies to crystallize a capital gains exemption or crystallize a capital gain before the end of 2018. So basically over the next 15 months or so. And so if you have shares, for example, that are held in a trust, and those shares qualify for the capital gains exemption, assuming the shares are qualified small business corporation shares, but the family has no intention of selling the company in the near future, they can elect to basically bump up the cost base of those shares inside the trust by filing this election. And it's important that you would do this in order to use up the capital gains exemptions of the beneficiaries. Likewise, this can be done outside of a trust by individuals. One of the big issues here, typically for shares of a private company to qualify for an individual, they have to have been held by that individual for 24 months or by a related person. And there is a rule, pretty strict rules on the asset composition that at least 50% of the value of the assets in the company have to have been used in an active business for a 2-year period. That 2-year period, for purposes of this election, is being relaxed, and it's being limited or reduced to 12 months. So transitional relief provided, planning should be executed in 2017, definitely, if you're looking to utilize the exemption. And if you're looking to do a lock-in, this election basically, by the end of 2018, you'd want to make sure, so that you meet that 12-month test, that the company is purified, i.e. that it qualifies as an active business or qualified small business corporation shares, and that might involve doing some planning currently. Best thing is if you do have a contemplated sale, if it could be completed within 2017, where under the old rules, capital gains exemptions are available without restrictions. The other thing to be aware of too, though, is if this election is being done in 2018, individuals with low or very little income who are claiming the exemption may be subject to alternative minimum tax, and that should be planned for as well. I've just got a very simple example here that we've put together. So assume Mr. A is transitioning the family business to his daughter, who's active in the business. So Mr. A was previously the sole shareholder and had no issues with respect to reasonability of dividends, even under the new rules. He has now introduced his daughter as a shareholder. She has the common shares and he has the preferred shares. So what changes can the family expect under these proposed rules? Well, because there are 2 family members as shareholders, they're each connected to the company. And it basically means that each individual is a specified person. And once you are a specified person, then any dividends that you take from the company will have to be reasonable under the new rules. So as a result, if Mr. A and his daughter do not meet the reasonableness test, they will lose access to their marginal tax rates, and dividend income will be taxed at the highest rates. Furthermore, going down the road, if they're in that situation and they have a future disposition of the shares, that capital gain could also be considered TOSI and taxed at the high rate, without access to the capital gains exemption. So this just sort of gives you an example of how severe these rules could be in existing or with existing family plans, and especially when a corporation is owned within a family group. I'm going to move on to the next section, and we will have time at the end for questions, as Sean had mentioned. The second part of the draft legislation, and this is a part that I should say is not draft legislation just yet. At this point, it's really just a paper, and it's out there for commentary from the public. So finance is looking at, and going back to one of my earlier comments, to put an employee on level ground with a corporation, where a corporation earns active business income. And I want to show you here just an example of how the system could work. So let's say that you have an employee who earns $500,000 in a year, and assume they're already in the high tax bracket and paying tax at roughly 54%. They would be left with $235,000 after tax, and assuming they don't need any of that for other personal expenses, then that $235,000 is what they've got remaining to invest in whatever, stock market, real estate, or anything else. If an individual has a corporation where they're carrying on their active business, such as a professional, a doctor, a dentist, or whomever, the first $500,000 in a corporation is taxed at the low business rate, which is 15%. Everything above the 500 is taxed at 26.5% in the province of Ontario. Corporate income tax in this scenario would be $75,000. The company would have $425,000 left over. And here again, assuming the individual does not need to pull the money out for personal expenses, they can invest as $425,000 in the company. And as you can see by the arrow that matches those two numbers, that is the issue that finance is looking at, is that somebody who's allowed to incorporate and earn active business income, which is taxed at a fairly low corporate rate, can defer the additional dividend tax when they take the money out by simply investing in the company, and they would have an advantage over somebody who cannot incorporate. On our second slide there, I just wanted to point out that when it comes to investment income, the system is fairly well integrated, same as you've seen on the previous slide, that once all the income comes out of the company, the total tax is roughly the same as if you went or earned it personally. When it comes to investment income, however, there really is no deferral advantage to earning investment income in a corporation, and that's because there is a fairly large tax, and it's roughly about 50% in total, but a chunk of that to the corporation is refundable when it pays out taxable dividends to the individual. So this is not the scenario that finance is really worried about. It's more worried about being able to shelter active business income in a corporation. Now, this deferral obviously is a major benefit to any corporation carrying on an active business. The deferral allows many things, and we all know that in a business, an active business, there's always risk. There's always fluctuations potentially in income. There could be lost earnings. Having a healthy balance sheet can affect lines of credits or secure more bank financing. Certainly, it allows for unforeseen contingencies, and in a lot of cases, it allows the shareholder or shareholders to build up savings for retirement, which they don't otherwise have. So, getting on to the next slide, this is where finance is coming from. So they're in that previous example, they're concerned about the difference between the $425,000 and the $235,000. So when it comes right down to it, and this, of course, is just a discussion paper at this point. I did mention it's not draft legislation, although the consultation period ends on October 2nd. It's hard to say if they're going to cut it off at that point, or if perhaps on this particular issue, they'll extend the consultation period. It's important to note that these proposals will not apply when investment in a company is focused in the business. So, for example, if you're purchasing equipment, machinery, expanding the business, whatever, these proposals would not affect income earned on those funds. It would affect what would be seen as being passive income. Now, as far as the options for putting this together, the Department of Finance has indicated in their paper that they've already, or they're looking at 3 potential options, and I'll call it 2 because one is an option that but probably won't work, and they don't feel that it's worthy of further exploration. So if we go to the next slide, the 1972 approach was the first thing that they looked at, and this was something that was introduced back in '72 when capital gains were also, or capital gains taxation was also introduced, and it was a tax basically that they were proposing to levy on the capital itself. So in our previous example, it would have been a refundable tax that would have been levied on that $425,000 to reduce the amount of money that the company has to reinvest. And part of that tax would then be refunded when dividends are actually paid out. So it would get rid of that ability to defer the income inside the company. What we know and what we've read in the papers is that the government is not actively considering this approach at this time. So we get to the proposal number 2. This particular approach is the apportionment approach, and this would require dividing passive income into several pools in the company. And so in our previous example, you'd have $425,000 to invest. The investment income would go into pools. One pool would be income that's been taxed at the low business rate, and another would be a pool that's been taxed at the high business rate. In any case, when the investment income is earned in the company, it would be taxed not at a refundable tax rate, which is what we currently have in the system for investments, but it would be taxed at a permanent tax rate of approximately 50%. Under this apportionment method, if we go to the next slide, what it really means, or the way it would work, is that the investment income would be taxed at 50% in the company, and then when the after-tax proceeds are paid out to the shareholder or shareholders, you'd have to divide the retained earnings into several buckets, including the shareholder's own investment into the company, and that determines how the income gets taxed on the way out. And it does seem fairly complicated. The third proposal, and this is what they call the elective method, is one where there's also a 50% permanent tax, but there would be no tracking required by the apportionment, as would be by the apportionment method. So this method here would basically say anything coming out gets taxed at either a non-eligible dividend rate of 45% or at 40% if the company makes an election and does not claim the small business limit, i.e. the 15% on the $500,000 of taxable income. This seems a bit more or less onerous than proposal number 2, but it remains to be seen where they go with this. On the next slide, I just wanted to go through a numerical example of what we're seeing, and I think a lot of you have heard that investment income is going to be taxed at 72 or 73%. And this slide shows you exactly how that's going to work. Going back to our previous example, the corporation had $425,000 remaining. If it invests at 10% and earns 10%, and the employee does the same thing with his or her reduced capital, then you'll see that they've got different investment return amounts in absolute dollars. Inside the corporation, under these special rules, the company would pay a non-refundable tax of 50% on that investment income, and it would then be left with $21,250 to pay out to the shareholder as a dividend. Assuming the shareholders in the highest tax bracket, they would pay 45% in the province of Ontario. After tax, cash to them would be roughly $11,700. If you look at the column under employee, the employee pays tax at roughly 50%, assuming they're in the highest tax bracket or close to it, and they'd be left with about $11,700. So you can see that at the end of the day, they end up, after everything is flowed out of the corporation, with roughly the same amount. But basically on the corporate side, the total tax that's been levied, both personal and corporate, is roughly 72 to 73%. So you can see that that's fairly harsh. But you can see also what the government is trying to accomplish. Oh, general comments on that. Keep in mind that these could have far-reaching economic impacts. Certainly, companies that may have fluctuations in their income and need to build up a reserve may have investment income in some years and not in other years. How that's going to be measured is going to be very difficult. The proposal would certainly reshape many retirement strategies that shareholders and small business owners have. There's also uncertainty as to how investments are going to be treated, whether investments in arm's length companies that, for example, hold real estate might be treated, and what really is passive. That's another complication here is they did mention, finance did mention that existing investments in corporations would not be taxed by these rules. So there will be grandfathering, but it remains to be seen how they will implement that. I would think that it's going to be very complicated. The main thing to note here is it's a discussion paper at this point. Really, there's no tax planning that can be done today, as anything that would be done is really just speculative at this point. So I think I will leave it at that, and as I mentioned, we will have time for questions after the presentation, and I'll turn it over now to my partner, Razik.
Thank you, Rosario, and thanks to all our guests for joining us on this webinar and participating. Moving on to the third area of the proposed legislation, the topic is really the conversion of income into capital gains. And to continue to build on what Rosario was talking about, essentially the government is concerned that the overall tax paid by an individual is not integrated had the individual earned the profit through a corporation. So the proposed new measures seek to eliminate tax planning that converts dividends or bonuses into lower tax capital gains. And essentially integrational concerns are that you should be indifferent as to whether income is earned directly or through a corporation, where the income is taxed at the corporate level, and then the retained earnings are paid out by way of a dividend to the individual, and the individual is taxed again. So overall, the same overall tax from profit to pocket should be paid whether incorporated or not. So to illustrate this, on the next slide, the Department of Finance gave an example of an individual resident of PEI in 2016 who's already in the highest marginal personal income tax rates, which for PEI is 51.3%. So assuming an individual gets an incremental income of $100,000 of capital gain as opposed to a salary, the federal and provincial tax savings on that would be $25,680. Assuming the individual gets $100,000 of capital gain and instead of a non-eligible dividend, again, the savings would be $18,180. And thirdly, assuming the individual gets an incremental $100,000 of capital gains as opposed to eligible dividends, then the tax savings are $8,530. So the government, as you can see from these tax savings, is concerned that integration is not effective when capital gains are realized at the corporate level and then distributed. So in order to address these concerns, the government expanded one anti-avoidance rule, Section 84.1, and introduced a new one, Section 246.1. Both rules seek to ensure that corporate distribution will be taxed as a dividend. It's proposed that these rules will apply in respect of transactions on or after July 18th, 2017. And keep in mind, legislation may retroactively capture certain transactions. Now, to get into these proposals in detail, the first one we'll look at is Section 84.1. And Section 84.1's implications could apply when an individual sells shares of a Canadian corporation to another Canadian corporation on a non-arm's length basis. And in doing so, the individual receives considerations for the shares in excess of their adjusted cost base in the shares, to the individual, and the paid up capital, or PUC, in respect of those shares. So once something like this happens, you will automatically fall into the legislation of 84.1. Now, to continue, if 84.1 applied to a sale of shares, proceeds will be taxable dividends rather than capital gains. Now, this could obviously in certain situations be problematic, particularly when family members are legitimately buying each other out. And the reason this is problematic is because typically the use of a purchasing corporation that is available in arm's length situations is not available for legitimate buyouts between related parties. And the use of a purchasing corporation is more efficient than purchasing shares individually. So again, these are obviously advantages that would be available if you were to sell your shares to a third party, but because you want to transact with family members, you fall offside. So to illustrate, we have an example here where parent owns Target 100%, and then parent sells shares of Target to child at fair market value and does not use his or her capital gains deduction. The child then sells the shares of Target to BICO and for a promissory note, and then BICO will, on that sale, issue a promissory note to child. Shortly after, Target Company will pay a dividend to BuyerCo. That will give BuyerCo the cash to repay the promissory note to the child. Once that is paid, child will in turn pay the promissory note to the parent, and the parent at the end of the day has received his money or her money and been treated the sale on a capital gains basis with careful planning, with the capital gain deduction not being used, however, paying tax at the capital gain rate. Now, with the new rules, we now have this. What will happen is the hard ACB that was basically established when parents sold Target to child is now no longer available, and when child uses BuyerCo to extract funds to repay the promissory note, child is now caught, and the promissory note is basically could turn into a deemed dividend to child. So the new rules propose to create soft ACB even when no lifetime capital gains exemption has been claimed on the shares. This is very concerning as it adds even more complexity to the intergenerational transfer and makes an arm's length sale that much more appealing. Now let's move on to look at another scenario in which these proposals could come into play. Estate planning will be our second example, and let's assume the following. Kate is a professional and she owns shares of Holdco. The fair market value is $2 million and the ACB is $100. Kate passes away. Well, immediately upon death, Kate has a $1.9999 million capital gain on her terminal return, and because this is a holding company and assuming it's got passive assets, the shares do not qualify for the lifetime capital gains exemption. There is now a potential for double taxation because Kate's got the capital gain tax on her terminal return, and then when the shares move to the estate, there could be tax on the redemption of shares and wind up of Holdco. So the solution in the past has been the practice, what was referred to as the pipeline. And to demonstrate the pipeline briefly, upon the death of Kate, the $2 million value is basically taxed as a capital gain immediately. Capital gains, assuming a rate of 24%, generates $480,000 roughly of taxes. The estate then is basically acquiring those shares from Kate upon death for $2 million. If we move along to the next slide, the estate can enter into a series of transactions that will allow it to extract some money to basically pay for the tax bill and also potentially leave the tax at $480,000 being the taxes on capital gains. So if the estate was to sell the holdco shares to NewCo at fair market value, which is $2 million, so the estate will get a promissory note as consideration, and it will have given basically holdco, which it has an ACB of $2 million to NewCo. So if we go to the next slide, we now have the estate owning NewCo, which will then own holdco. At this point, we'll have holdco distribute property to NewCo, and this is done by way of a tax-free intercorporate dividend. After this, NewCo will use proceeds of the dividend to repay the promissory note that was originally given to the estate from NewCo of $2 million. So this obviously has achieved what we discussed earlier, is an overall tax of $480,000 being the taxes on capital gains. Now, with the new rules, if we just step back to step 2 and look at the estate sale of holdco shares to NewCo at fair market value, the new rules will basically step in immediately and block the pipeline such that the promissory note can no longer happen for $2 million. So now if we move on to the next slide and we take a step back and look at the numbers and what this means to the deceased, the estate, we see that the pipeline planning achieves an estate tax liability of $480,000. The estate planning with no pipeline, assuming again now we're into the dividend rates, and assuming it's a high rate, we're now looking at a tax liability of $840,000. So obviously this is a much higher tax bill than what was previously available to taxpayers. Now, be careful that if planning is now required so that you don't get into a situation where you're basically paying capital gains tax and dividend tax at the estate level. So you could essentially, get into taxes in excess of $1 million. So you want to be diligent in planning upon death within the new regime. The second piece of the surplus stripping, or the new anti-avoidance rules, is Section 246.1. And this new section intends to prevent the distribution of corporate surplus to an individual shareholder, which would otherwise be distributed as a taxable dividend on a tax-reduced basis in a non-arm's length context. The tax community is concerned with the broad language and ambiguity of the new rules. Let's dig deeper. So an individual is treated as having received a taxable dividend where the amount received or receivable is part of a transaction or event or a series of transactions or events if the following conditions are met. The individual is resident in Canada, amount was received or receivable from a non-arm's length person, including an accommodating arm's length intermediary, there's a disposition of property or change in paid-up capital of a corporation, and it is reasonable to consider that one of the purposes of the transaction was to effect a significant reduction of assets and tax payable is avoided. Again, very broad criteria. So it's currently somewhat unclear as to the application of these new rules as regular non-offensive transactions such as tax-free return of capital, tax-free capital dividends, or even potentially a repayment of a fully tax-paid loan may now be subject to recharacterization. And even more specifically, where the new rules apply to recharacterize a capital dividend or any other tax-free amount paid to an individual, to be a taxable dividend, that tax-free capital dividend account arising from the series of transactions is also reduced, which is very concerning to us. To regroup on these new anti-avoidance rules, obviously our concern is clear that these may capture routine business transactions and could create adverse tax consequences. For example, sale of business assets or a portion thereof, which creates a capital gain, sale of investments or commercial real estate creating a capital gain are typical transactions that we're concerned with here. I would like to here summarize by saying that it's important to seek professional advice if you are reorganizing a business, selling assets, or transacting on the basis that you may realize a capital gain and plan to pay out a capital dividend. And that brings us to the end of the third section, and I now turn it over to Sean.
Well, thank you, Rosario and Razik, for taking the time today to share with us details on the latest federal tax reform announcement updates. I am confident that the information that has been provided will help our listeners keep a step ahead of the changes and ensure they meet the compliance requirements and regulator expectations that arise from the changes once they are finalized. Sorry. So there's been some questions coming from our audience that we've been collecting throughout the course of the webinar. Just being conscious of everyone's time, we will be sending out the questions with answers to all of the registrants, along with the content and the presentation that was discussed today, later on, like I mentioned earlier. But we're going to take an opportunity now to answer some of the questions. So Rosario and Razik, first question. What do the changes mean for the multi-generational succession of my business?
Yeah, I'll take that question. It's a great question. Obviously, it's an area of concern to a lot of Canadians and a lot of family-owned businesses. We believe that that this is obviously a concern. This draft legislation is still in draft, and we hope that the government will take into consideration criteria in which genuine intergenerational transfers can be demonstrated, and if such criteria is met, then these rules will not apply to such transactions. Again, we don't know with certainty at this point, but again, the answer will depend on what your structure looks like right now, whether there's a family trust, whether you have other family members involved in the ownership or not. So for the time being, it's good to sit on the table, discuss your structure with your advisor and your tax specialists, and then be prepared to take action, as Rosario had mentioned earlier, where needed for changes before year end. And when it comes to the structuring, we have some time, potentially into 2018, to make changes. But again, let's maybe see where the changes will come in the legislation and move from there.
Great. Thanks, Razik. Another question that came through, maybe a bit of a recap. What will happen with my current share structure in which my spouse and adult children are shareholders?
Okay, yeah, I will take that. So as you saw in my portion of the presentation, after 2017, there'll certainly be issues for your family members who are shareholders, either directly or indirectly, even through a trust, if you plan to pay them dividends. So that is certainly something that has to be looked at. Going even further, what could be impacted even more so, and where you could do some planning, is that if there isn't an imminent sale of the business, or you're not planning to sell it anytime soon, I don't think you'd want to go beyond 2018 without getting a kick at the capital gains exemption, assuming some or all of your family members still have it available. So definitely keep in mind the election that I had mentioned, the fact that it can be done by either individuals or a trust, and certainly if that's something that that you're looking at, and I would I would assume that many family businesses should. Then it's important to do some planning now to make sure that that exemption is available to you in 2018.
Great. Thanks, Rosario. So once again, just wanted to say thank you again to Rosario and Razik for presenting, and for all of you that took the time to join us this afternoon. Should you have any questions after having some time to think about the materials presented today, please reach out to your partner if you're a client, or to the contacts that we've put up on the screen for you guys. Please feel free to reach out to them, and we can connect and answer any further questions, maybe share some further examples to questions that you might have. For the associations, once again, we'd like to thank you for inviting your constituents today. We understand that these changes as proposed will have a significant impact on your constituents. And should M&P's assistance be required to assist with economic impact studies or other studies to help further inform your constituents, please feel free to reach out to Ezio or myself, and we can discuss the next steps. On behalf of M&P, thank you once again for joining us today, and we look forward to hearing from you. This is the end of the webinar. Have a great day.